Hi everyone, today we're here with Zach Lofeudo from Vericon Mortgage. What we're going to talk about today is, first of all, everyone knows interest rates have gone up, so we're going to discuss that and how to refinance your current property, turn that property into two or more. So Zach, let's get into it. What's happening with the rates these days?
They just keep going up, my friend. So we got to be aware that we're in a raising rate environment. So lots of things you can do in this to protect yourself if you're shopping, if you're refinancing, if you're looking to do anything or make changes to your mortgage. But the biggest thing is to realize that you're not going to be paying, the prices of the mortgage payments that you were able to get even 6 months ago, right? Even 3 months ago, 2 weeks ago. Like the rates just keep going up, right? So if you're going to make a move, if you're going to do something, you should jump in. You should find the property, place the bid that's going to win, get in there because you're locking in at least the rate that is today. Even if you're pre-approved, even if you have a pre-approval, a lot of the times banks, mortgage brokers, wherever you're getting your pre-approval are actually going to be placing it at 25, 50 basis point premium because they know we're in a raising rate environment.
So let's talk about that. So I know for a lot of my clients, I tell them they have to have the pre-approval. A lot of times they go in, they get a rate hold, and I know the rate hold, usually they give it for the fixed rates, right? So they're like, 90 days, 120 days, they get it, then, they can go shop knowing, this is how much mortgage they can afford at this rate. What about the variable rates?
So you are able to lock in variable rates or the discount off of prime. So you're not locking in the variable rate, but a variable rate is whatever the prime rate is, subtract whatever the bank's going to give you, right?
So as an example right now, what is it, like the prime rate?
Prime minus 0.65 is where you're seeing a lot of the monoline lenders at. Banks a little bit higher. Potentially by the time
a lot of people don't know what a prime rate is. A prime rate is the bank rate. So right
now,
now,
prime rate is what you see in the news of rates are rising. The sky's on fire. That's what's happening. So it's actually the Bank of Canada raising that prime lending rate or the overnight rate, and that in turn the banks raise their prime interest rates.
So the variable rate, they can hold it.
So there are certain lenders that will do that, certain lenders that won't, but you're holding that discount off of prime. So that way they're protecting themselves. It's not like they're giving you 1.5% or now more like 2% or so. They're not going to give you 2% if the prime rate continues to rise. The Bank of Canada meets again.
So like what we have right now.
Exactly. So the Bank of Canada meets again, rises 0.25%. Well, you're not going to get 2%. That discount is then going to bump you up to 2.25%, right? So you're actually locking in prime minus 0.5%.
Got it. So if you were to have a variable rate right now that it wasn't locked, it could be a better rate as compared to locking it down slightly.
Exactly.
But that will give you an assurance knowing this is locked and you can go and purchase
Exactly. So like I said on that basis point premium that lenders are going to give you, it's the same with the variable rate. So say that the actual fixed rate is 3.5% that went in. I'm not quoting rates right now. They're different with different banks. Just using this as an example. Rate's 3.5%. Well, they're actually going to give you 3.75 or 4% even. That's your rate hold that we'll give you for 90 days because they know we're in this raising rate environment. It's very likely that the bond yields are going to go up and we're going to raise our rates again in that time period. So we're actually going to put a premium on there to protect ourselves a little bit, or the lenders protecting themselves while you go shop. Now it's still a benefit if the rate goes above that. Right, then you're still locked in at that rate that they've given you, even with the premium. So that's where you're going to win. But to go back, sorry, I kind of got a little bit off topic here. One thing you said around making sure you're pre-approved versus a rate hold. A lot of lenders, mortgage brokers, myself included, previous to this last 6 months or so, or when we've been in the raising rate environment, I wasn't even really bothering with a lot of rate holds because I know the rates were low. If anything, we're probably going to be lower than where we locked them in, especially with the basis point premium.
So the question I have is, if you lock down a rate and the rate hasn't gone up, can you be like, listen, you know what, I want the lower rate?
Exactly. So you're always going to get that available floor rate.
Okay.
So it's not like you're locking in.
It's to your benefit to do it.
Exactly, especially now. So prior to 3-6 months ago, wasn't even really bothering with it because I'm like, okay, rates are low, and a lot of people had the same mentality. maybe a little bit longer than 6 months ago.
Yeah.
When we've been in this raising rate environment.
Because they were supposed to
definitely-
increase the rates last year, it didn't happen. It happened this year.
Yes, exactly. So no one has the crystal ball where they know, okay, this is what the Bank of Canada is going to do. We are expecting a rate increase, like you said, prior to the one that we had, it didn't happen. Now we got the quarter point increase. We're probably going to see another one very soon, right? It's got to curb inflation. They have to curb inflation somehow, they being the government and Canada, and that's the way they're going to do it.
So since we're in the same topic of, rising interest rate, I know they said there's going to be a few rate increases, but again, what's your take on that?
Like a lot of people are saying, and as I just said, no crystal ball here, but at least another, 3 to 4 rate increases over the next year and a quarter, right? That 1% increase from where we were a couple months ago is what a lot of people were budgeting or factoring in, or what I do with my clients as well. We say, okay, we're going to go with a variable rate because you are going to save money, or variable or adjustable rate, because you are going to save money. It's a difference of still a spread of 1.5% right now. It's crazy that the spread still exists at that much. So you are going to save money going with it, but we're going to factor in with the variable or adjustable, which we can talk about in a second. There are 2 different products there. But you're still going to save money. But we're going to factor in these rate increases, and I'll actually do a chart and analysis here if it does increase, because you got to think it's got to go past where the fixed rates are for it to not be worth it. It's not just catch up to where the fixed rates are. Well, you've saved money over a year and a half of it being lower. So now for a year and a half, it has to be higher to actually negate the savings that you would have had with a variable rate.
And what I liked about what you said was not having a crystal ball, because even last year they said they were going to increase their rates, and then we had the Omicron come in, and everything kind of nothing moved till this year, and now they were talking about few rate increases, and no one knows what's going to happen. So getting that pre-approval and the rate hold is key. Mm-hmm. So in terms of the best rates out there, what have you seen? What's the range you're seeing right now?
So range we're seeing on owner occupied Refinance Is.
And again,
purchase.
this is as of March 2022.
Yes, but even so, last week it was different.
Yeah,
but
exactly.
it is this week, and next week it might, because we're in such a volatile rate environment. So I'll give a range around 2% still on the variable side. Right. If it's insured purchases, still seeing a lot lower than that, even close to 1.6, 1.5% with certain lenders. And the fixed, we're just seeing continue to go up and up and up. So 3.5, 3.6, 3.7%.
That's crazy, because I remember, what was it, a year and a half ago, they were doing fixed at 1.7?
Yeah, I saw renewals, I remember, because I was like, this is a great renewal. I can't even help you take it. It was 1.54 fixed for 5 years. I was like, run with that.
Like a client of mine,
crazy.
actually, when they purchased a property, and I remember they were talking about variable and fixed, and I think they came to me, it was the fix was around 1.7, and I'm like, I couldn't believe it. For 5 years, you get 1.7, they're already ahead.
Yeah, there was a time right there that it changed from the fix started going up to that 2.5%, and the spread just kept getting lower, and the discounts off of prime kept getting higher for the variable side. So we're getting clients, 1.2% on a variable, and then it was 2.5 or something on the fixed. I'm like, well, the spread's too good for you to take almost 1%, or even 0.99 that HSBC had for a while, less than 1%.
That's
interest
crazy.
rate
Did that even exist?
It did. It was out there. We did. We did have access to it.
It had to be insured mortgage, though, right?
Yes, it was an insured mortgage, so under $1 million, less than 20% down, that sort of deal. But it was out there. There's people, amazing. And it was actually a good mortgage product, surprisingly.
So let's talk about the variable and what was the other one you said?
Between variable and adjustable rate.
Adjustable rate.
A lot of the times this is thrown around interchangeably by bank financial advisors, people like that you're sitting there and say, oh, you have a variable rate. Well, you actually have an adjustable rate. The difference between the two is an adjustable rate mortgage. When the prime rate increases, your actual monthly payments increase with the prime. So you have $2,000 a month. It goes up 0.25%. Now you're paying $270 or $2,070, whatever the mortgage amount is in the increases. With a variable rate, it's actually a static payment for 5 years, locking it in at whatever that variable rate discount is at the time. Just the principal and interest within that that mortgage payment change. So if as the interest rates climb, you're paying less principal. But I suggest this for a couple reasons. One, if people are worried about cash flow and the increasing rates, and that if it increases by $200-$300 a month, that would actually have a big factor on them. Or say if you had like a rental property and you wanted, your rent was going to be this, you want to make sure that, all your numbers sort of stay the same. You have property taxes.
And is this a product that a lot of lenders offer?
A few banks offer it. I know TD does in the broker channel for us. So that's where I send a lot of business if they're worried about doing something like that. But you are going to find, they also have a very competitive rate on variable, and they do it a little bit differently, and you get rate exceptions based on the mortgage amount and the actual whole file itself, instead of just like this is our rate and this is what you get. We can actually kind of negotiate a little bit more with them and lower it down there. But you are going to find better break penalties or particulars or terms of the mortgage, probably with a monoline lender, and you're going to find a more competitive rate right now anyway than the big banks. So going with First National, MCAP, RMG, that sort of thing.
Okay. Yeah. So since we're talking about the variable and fixed, so let's talk about, because I know as a personal experience that I had with a client, when the rates were low, a client of mine, when I saw the 1.7, I went to them and they had a lot of equity in their property. And what I suggested was that taking the equity out at that low of a rate of 1.7 and refinancing a property and buying another property with it. So they actually ended up buying a condo in the summer of 2020, which we know condos were got hit pretty bad.
Yeah.
As of January, their condo is up 42%.
Yeah.
And the rate is locked at 1.7. So that gets us into the whole topic of refinancing. Mm-hmm. So just tell us what the whole refinancing is and how it works.
So let's backtrack right to what a refinance is. Essentially, increasing your mortgage amount. You can change your amortization and increase your amortization. Again, you're renegotiating your mortgage, and whatever the mortgage and or debts you're paying out, subtract the new mortgage amount is the equity that you can access from your home, and that'll be cash in your bank account. It's tax-free because it's actually a debt. It's not income, right? You're actually increasing your debt and taking the money out. But then you can do whatever you want with it. Either put it in traditional investments, stocks, bonds, mutual funds, or go ahead and purchase another piece of property, which is what I do a lot of budgeting for my clients to make sure that they know it's going to work as well. You don't want to just take out a bunch of equity and then you're sitting on it and you can't qualify for another mortgage. There's a lot to it in terms of putting together a budget. But a refinance is just that. It's a way to access the equity in your home without selling the property, right?
That's great. So just taking it into the real estate, let's say someone wants to refinance. What do they need to consider that they want to take that refinance, the extra money out and purchase another property? What do they need to first have prepared if they're going to get another mortgage on another property, and what they need to know personally in terms of their own finances and the extra costs they may have?
Right. So one, you're going to need everything that you use to qualify for your original mortgage. You're getting a new mortgage. So if you're employed, employment letter, pay stubs, T4s, if your income fluctuates, if you're self-employed, full T1s, NOAs, you need the whole shebang. You're not just saying
brand new requalification.
Exactly. And you could stay with the same lender that you're with and just top it up and they give you some equity, or you go elsewhere. A lot of the times we'll look at other lenders because the lender that you're with might not have the best rate at the time. Yeah. It might have at the time that you were doing it, especially in a raising rate environment that we've been talking about, right? So to access that equity, one, yes, you're going to have everything that you need to requalify, especially if we're going to another lender, right? Even if you're staying at the same lender, but if you're going to a new lender, they don't know you. We need to requalify entirely. You're going to need to make sure that you qualify for that amount, right? You can't just access the equity just because it's there. Yeah. You still need to be able to qualify for, if you have a $500,000 mortgage now, you want $200,000, and you're going up to $700,000. Well, you need to qualify for a $700,000 mortgage. If you didn't in the first place, unless you've increased your income and paid down your debts, you won't now, right? And then, especially going into buying another property, you want to have a full plan and budget in place. So a lot of the times this is how I'll do it, is take the new mortgage amount before we even go and refinance, right? Yep. So this is what the monthly payment's going to be. This is what your new debt's going to look like. And then from there, I'll put the potential new purchase. So say we're taking out, $150,000 to buy a $700,000 investment property, putting 140 down as a 20% down payment, closing costs, that sort of thing, as an example. So then I'll go and do that refinance on paper, see what it looked like with the new debt, and then go and add that $700,000 property with the potential rental income, because we can use that to help qualify for the new one.
So that is the key thing. So it's got to be a rental property that you have.
Yeah, well, you can do it. You could do it either way, because for example, a client I just did this where we finalized her refinance a couple weeks ago, and she just bought a new condo to purchase.
Yeah.
What she's doing is she wanted to move up into a nicer condo. She had a smaller, 500 square foot condo that was worth about $500,000. It had a low mortgage on it. We were able to add 150, almost that exact scenario, add 150,000 on, so she had a $350,000 mortgage. Take that equity out. Then she used that to buy a larger condo, and plus some savings as well.
Right.
But then we use that, and then we use the potential rental income from that property that she's moving out of to qualify for the new loan. So we get what's a market rent appraisal on that.
So either one of them is going to be rented, and then you use that income.
So you can use a part of that income, and there's certain calculations that we use, and some lenders are different of how much rental income they'll take to qualify, and if they're going to add to income or use it as a gross offset to the costs of carrying the property as well.
Right.
So it's different, but that's the sort of nitty gritty of really figuring out the qualifications. But that's essentially how we do it to get you to qualify for more. That helps. But really, when you are moving one to a rental property or turning the other one into a rental property, if you can kind of make it neutral, like in this case, it was almost neutral. She had a very low mortgage payment on it because we got her a good rate at the time. It was a little bit before the rate hike, so we were able to lock something in low. It was, I believe we went with TD, so it's a static payment. Mm-hmm. So even if when it did go up when we were going to purchase the new property, well, her payment stayed the same.
Okay.
And then her rental income on the unit was going to be, $2,000 or whatever the potential rental income. So it sort of offset it. And now all we're doing is qualifying for a new property. That's sort of like a wash almost.
So that's my question. Does it have to be a complete wash in terms of mortgage payment and the rental? Or no,
it doesn't have to be, but then it's just going to be a liability, right? So it's going to.
Then you have to have enough income to cover it.
Yes, you have to have the income to support that difference, right? So if it's a liability, we take that portion, add it to a debt or a certain monthly payment. That's obviously going to affect your new qualification, but as long as if you can cover it, especially if it was a couple of dual income that's even decent, right? Yeah. Even decent dual income, you're probably going to be able to offset that smaller cost and then move up to another one or have the rental property.
So this is what's fascinating to me, because a lot of people can turn one property into two, and then from there on, like within 5-6 years, have multiple properties. I mean, a client of ours bought the Thompson Hotel a long time ago, one bedroom, pretty small one, and what happened was saw the growth in the condo. So within I think 3 or 4 years after closing, he refinanced, bought another pre-construction condo, and that's when the pre-construction boom happened in 2016, 17, and saw the growth on that. So it ended up happening, his own house, he had so much equity that pulled the equity out, ended up buying 2 more condos. So right now, I think his rental income is, essentially he could live off the rental income of the properties, yet paying off all the mortgages. So that's what's fascinating about like refinance.
Exactly. And then you're growing appreciation in not 1, but 2, but 3, or 4 or 5
and the equity
properties,
that he's sitting on probably it's like, it's crazy.
And that's what I try and plan for if the client is right for it, if they want to do that and start building a real estate portfolio. Yeah. I show them the power of, especially in the last couple of years, when we've seen 20, 30, 40, 50% equity growth in certain areas around Ontario. You can access that, increase your amortization, which is a little bit, people have to wrap their head around. Well,
from 25 to 30.
Exactly. Or I've paid my mortgage down to 20 or 18. Like I've had my property for 5 years. I've been paying it down. Well, now we're actually going to increase it back to 30. But we're going to take some equity out.
So increasing it back to 30 brings down the payment.
Exactly. Yeah. So then that way we can keep the monthly payment essentially the same, but take out 100, 150, 200,000. Right? And then we can go and buy another property, and then that property's rental income can cover itself. All of a sudden we're looking at your payments the same. It's $2,500 a month. But you own 2 properties building an equity because one's being covered by the rental income.
Because again, like the equity appreciation, especially in Toronto, is so much that a lot of people are counting on that. I mean, even if they're sometimes negative on like a few $100s, that kind of takes care of itself because a lot of rent that you pay. I mean, I think when we had the low interest rates, almost 60-70% of the payment was going towards the principal. And, you got your tenant paying not only your interest, portion of your principal, even if you're out of pocket a few $100s, that's essentially like a savings in your bank.
Exactly.
So you're gonna have access to it. It's not like you're paying interest on it.
It's the same as if you were going to invest that $300, $400, $500 into RSPs or into some sort of fund that even if that was increasing by 10% per year, it's not going to build as quickly as appreciation, and especially in Toronto, but anywhere in Ontario, it's still going to be a 7% average appreciation.
That's been historic. But I mean, like condos right now, I would say since beginning of January have gone up like on average about 12%.
Exactly, and that's great for people that got in. I still like to be, even more conservative with people, and that's why I tell them, okay, 7% on average over the last 30 years. So let's look at those numbers. Yes, this is great. We can get you in a condo.
No, it's got an up and down. You got to average it out.
It's probably going to be, if you bought a condo today, you're going to make 10, 12% appreciation this year, next year. But even if it slows down, let's look at the average, right? Let's play the long game on this, and let's buy 1, 2, 3, 4, 5 properties down the line and show you your net worth growth. Right?
So what I see personally with a lot of my own clients, people struggle with the idea of refinancing because they've been told they got to pay down the mortgage, have no mortgage, and that's somewhat of a victory for them not to have a mortgage. But I mean, like when you're paying like, what are you, like, sub 2%, like, what are the struggles you see with people refinancing?
That's definitely sort of something that people need to wrap their head around, or just like a new school way of thinking, because their parents or their grandparents probably said, like, you gotta, put more money in your mortgage, like take all your earnings and put it in your, and pay it down to zero, and then you've won. Well, that's going to get rid of your, $2,000, maybe $1,500 a month monthly payment, which is great. That's nice to have that much more cash flow in your pocket. But then now you have this, this house that's building an equity, and to access it, well, you'd have to refinance. It's kind of ironic. You have to refinance to access, or put a reverse mortgage on it. Even more ironic. You've paid your whole life to get it down.
And the whole idea of it is the fact that when you are actually taking that money out, again, power of leverage. You put down 20%, you're locking down, let's say $200,000, you're locking down $1 million. Even if that's going up by 7%, that's $70,000 equity. You've held that property like for 5 years, $350,000. You can buy, you can put down another for probably 2 more condos with that money. So that's the whole idea that people need to wrap their head around.
Exactly, like using leverage in general, using other people's money, OPM, my favorite saying I like to use. It's just using the bank. If you have a mortgage, you're already using other people's money. It's using TD and Scotiabank and CIBC, RBC. It's using their money, right? And that's to buy more properties, which is how you win, which is how you really build, your net worth. It's what the wealthiest people in the world do. They don't use all their own money. They're borrowing money at 3, 2, 1%.
Especially at these rates.
And at these rates, even rates that are a little bit higher, like, as we just were talking about, 7% average appreciation, even if you're borrowing money at 3% or 3.5%,
covers it.
It still is covering it. You're still winning in the long game, right? And that's what people have to think about too. This isn't like, I'm not talking about buying a property and it goes up 10% and then you sell it the next year, and then now you've made $50,000. Well, now you got capital gains and you're paying a realtor to no, it's talking about 5, 10, 15, 20 years holding properties and using them to leverage to buy more.
Okay, so anything else about refinancing we should know?
I mean, I think we covered a lot here. It's pretty good.
Another thing I wanted to talk about is also this whole idea of the stress test, especially on the variable and fixed rates right now, because with the fixed rate going up, how is that affecting affordability for a lot of people?
So I was just talking about this with a colleague of mine, and anyone that has rate holds or pre-approvals out there right now. A lot of people were talking about this, I think, a little prematurely. It was maybe a couple months ago. I saw some Instagram posts like, oh, it's going to affect your qualifying amount. It wasn't at the time because we were still seeing sort of 3% fixed rates. But now that we're seeing 3.5, 3.7, right, the way that we qualify mortgages is you have to qualify at 5.25% in order to carry the mortgage, or what the contract rate is plus 2%. So if you're regular qualified for $500,000 at 5.25, well, now if you're getting a fixed rate, you're actually going to qualify at 5.7 because you have a 3.7 fixed rate plus 2%. So that's actually going to bring down your qualifying amounts. I don't have the exact number off the top of my head, but it will affect you by a few, like tens of thousands of dollars. Now, if you go with the variable rate, you have a lower rate there, so you're still qualifying at 525, right? So you can still access a 2% variable rate, because 2 plus 2 is 4. You're still at 525 as the lower of
So if someone really specifically wants to go for a fixed rate, their affordability could get hit.
Exactly. And if you have something that's, you might be locked in right now or pre-approved, and maybe your 90 days has run out or anything like that, that could affect it, right? If you had a rate hold from 90 days ago, now it's run out, now your fixed rate is 3.5. Well, now you've actually affected your affordability and qualification, because you can't use that locked-in rate from before.
Interesting. Just to wrap things up, another question that I have. So let's say someone goes with variable. How does it work if, in a few months, few years, within that 5-year term that they have, they decide to make it into fixed, and like if they have a fixed, can they change it into variable?
So if you have a fixed, you can't go backwards on that. You're fixed, you're locked in for 5 years. If you want to break or refinance at all, there can be big penalties. Depending on the lenders, the cost can be very high. So it's almost like when you have a variable, you have a little bit of insurance as well, that if you do make a change, it's only every 3 months interest. So if your mortgage is large, I would definitely suggest doing that, because if you have a break penalty on $1 million mortgage, it can be huge. I've seen $50,000, $60,000, right? Which can be crazy. Life happens. But if you need to sell the house, or you need to move, or something, God forbid, something bad happens, right? So you can't go backwards from sort of fixed to variable. You can lock in your variable to fixed at any point. But something that I like to say as well, if you're going variable, you should sort of commit to riding out the variable, right? So if you're going to have the savings at the start, and then it starts to match the fixed, well, if you lock in, now you're at a fix, you don't have the benefits of being a variable, and you've already saved all that money. So as we said, I think a little bit at the start, it would actually have to go and increase higher than the fixed and stay there for a long time for you to negate the savings over the long term of staying in a variable.
So right now, if someone is getting a mortgage, which one would you recommend?
I'm still saying variable all the way. I generally am. The only time I really, say someone should go with a fixed is if they're going to lose sleep at night. If there's someone who's very, very conservative, risk adverse, and I tell them all the benefits of the variable.
And if their monthly income is very consistent, I would say.
Exactly. So if they can't afford that ups and downs, now there are, like I said, the options to go the variable with the static payment. But if it's going to turn your stomach in knots and you're not going to be able to sleep, then just stick with the fixed and find the lowest out there.
Stick with the fixed or variable?
Stick with the fixed, but for my clients, I'm always go variable first, show them the option, variable or adjustable, show them the options, show them what the rate increases are going to look like, and then make the informed decision.
I'm always for variable. I've always had variable, but like that one time that their rates were so low, that was
a time that, like I said, like certain clients, even their renewal, I'm like, I can't beat that. I could get you a lower variable, but I said take crazy, that all the way home. Like
for 5 years you're locked in.
Yeah.
Well, Zach, thank you for joining us. Very informative. And if anyone has questions, feel free to reach out to Zach. We're gonna have the information down below. Don't forget to subscribe and follow us. Thank you. Bye-bye.
Thanks.